Hello. In this video, we'll review the procure-to-pay process that merchandising companies use to purchase and sell inventory. Merchandising companies, like our textbook example, Max Out Sporting Goods, purchase goods for resale and therefore have additional expenses that are called cost of goods sold. When we subtract these costs of goods sold from the net sales amount, we arrive at gross profit and the gross profit percentage. This is a very important number because it tells us how sustainable this business is, because the gross profit needs to be large enough to pay for all other expenses and still leave enough profit for the owner to draw money out of the business. The operating cycle of a merchandising company starts with the purchase of products. We'll talk about how this purchase process works, including purchase requisitions and purchase orders. Next, the merchandise inventory is received and stored for sale, and we'll talk about controls that companies should have over this merchandise inventory and the inventory systems that companies use, the perpetual and the periodic inventory systems. The merchandise inventory is sold for cash or on credit, and credit sales create accounts receivable. And we need good processes and a good credit policy to manage these receivables. Customers will eventually pay, hopefully timely, and the company collects the cash, which in turn is used again to purchase merchandise. Every step along the way, the company should have safeguards in place that prevent fraud and loss of products. The first step in the operating cycle is the purchasing step. Merchandising companies purchase goods for resale and must have good processes and accounting processes in place to ensure that only an authorized person places the order, that vendors are pre-approved, and that the goods are received by someone else than the person who ordered, and that the accounting department compares the order to the receiving document and with the invoice from the vendor. The entire process from ordering to paying the invoice is called the procure-to-pay or P2P process. And the matching of the order to the receiver to the invoice is the three-way match. A large firm usually has a centralized purchasing department that is responsible for locating suppliers, obtaining price quotations, negotiating credit terms, and placing orders. For instance, when I worked for Kaiser Permanente as the pharmacy controller, I saw firsthand how much effort goes into procuring medications, medical, and other supplies. Sometimes prices changed monthly, and the purchasing team was on constant alert to source effectively and efficiently because, after all, companies can't immediately change prices when suppliers increase their prices. In small firms, purchasing activities are handled by a single individual, usually the owner or manager. Most merchandising companies buy on terms or open account arrangements. That means that they receive the goods and the invoice but don't have to pay until later, often 30 days. Purchasing is one of the areas where fraud and theft can easily occur. That is why auditors focus on this area, and companies should protect themselves from fraud and theft by having different employees assigned to different parts of the process, and there should always be a good review process. The procure-to-pay or P2P process starts with the need to order product. In large companies, the inventory management system might show that the product inventory is low for an item and that the product needs to be replenished. In small companies, the owner may review the warehouse inventory and decide that a product needs to be reordered. Or the company identifies that it wants to sell a new product that it has not sold before. In either case, the company identifies the need and now must formally issue a purchase requisition that details the items to be ordered. It must be signed by someone who is authorized to approve requests for merchandise. After all, if the incorrect orders are placed, it could be a very costly mistake for the company. The purchase requisition is then submitted to the purchasing department, which is tasked with reviewing the items that need to be ordered and identifying a vendor to place the order with. A large company might publish an RFP or request for proposal, which means that they ask multiple vendors to submit their best offer to the company. In most cases, companies will just identify a few possible vendors and obtain a bid or place the order with an established vendor. If it is a new vendor, pricing needs to be agreed upon and payment terms are negotiated. In addition, the company might want to closely review the vendor's reputation to ensure that they are a good vendor that the company wants to be associated with. Once these steps are completed, a purchase order can be issued to the vendor but must be signed by an authorized employee. The purchase order protects both the buyer and the seller. The purchasing company does not want to have to pay for purchases that are not authorized. And the selling company does not want the risk of not collecting undelivered merchandise. The selling company should insist on a purchase order before delivering merchandise. What is the next step in the P2P process? The company waits for the products to arrive. In some cases, that can be a long time. And if that is the case, the company needs to manage its inventory effectively to not run out of inventory. I once worked for a company in the automotive industry, and sometimes it took over 6 months to receive car replacement parts. Many companies establish what is called reordering points. Let's say you sell the product on average 10 times a month, and it takes 3 months from placing the order to receiving the products. You likely want to place the order when you have 40 items of this product left. Keep in mind that your sales quantity can vary from one month to the next. The customer demand could suddenly increase or decrease, and it could take longer to receive the order from the vendor. All these variations could influence how early you place the order before you actually need the products. Also, the price for a product can suddenly increase, and you need to be prepared to source from a different vendor, adjust your selling price, or come up with an alternative product. For instance, when I worked in the accounting team of Baja Fresh, there was a time when tomatoes and chicken prices increased significantly when those two items made up a significant part of the menu of Baja Fresh. Some companies even hedge this risk by participating in the futures market. But let's talk about the next step in this process. Once the company receives the product, a receiving report is prepared to show the quantity and condition of the goods received. The receiving report should be prepared by the receiving or shipping department, and neither the person who requested the product nor the person who placed the order should be involved in the receiving process. The purchasing department receives a copy of the receiving report and compares it to the purchase order. If there is a problem, the purchasing department will contact the vendor to resolve the problem. The accounting department receives the invoice from the vendor and compares the invoice to the purchase order and receiving report, checks the quantities, prices, and math on the invoice, and then records the purchase as soon as the invoice is verified. The payment is then scheduled close to the due date of the invoice. I hope you found this video about the P2P process helpful and informative. Please let me know if you have any questions.